And now our next guest recently switched his overall market outlook from bearish to neutral. So what's driving his outlook and which sectors still have opportunity? Joining us now to discuss his thoughts is CNBC contributor Greg Branch. He's the founder and managing partner of Branch Global Capital Advisors. Greg, that CPI report, part of what turned you around here or continues to have you around at least at neutral?
Yeah, I think that was the final piece, John. When you look back at my thesis throughout the year, it really rested on three things. The first was that the core growth for the last 16 to 18 months had been in a narrow band of 30 to 40 basis points. And while we had some head fakes of 20 basis points for a month or two, we never broke out of that band, and that doesn't get us to a sustainable 2%. But when we saw the number from May at 0%, and then that followed with a 10 basis points hike, 10 basis points increase in core, you had some belief or you had some conviction that we were in a new paradigm, a new step down. That was supported by the fact that unemployment, which had also been one of the challenges in changing my view, where it was in that stubborn 3.6, 3.7% range. Well, for the last 3 months, it's ticked up, and now we sit at 4.1, a very short distance from what the Fed said it needs to get to sustainable 2%. And lastly, occurring coincidentally, was the first time that we saw a real break in the housing component with only 20 basis points. That was the lowest we'd seen in 3 years. All of those things occurring at the same time, I think makes it really hard and made it really hard a few weeks ago to continue with a bearish posture.
So if you're underinvested here, what are the sectors where you should be putting money in?
So I think that depends on whether or not you think this is a sustainable rotation, John. I don't yet have that conviction. And so our exposure and where we're targeting our exposure continues to be the same as when we were forced to widen back in December when the Fed full pivoted. And for us, that means one of two things. That means either focusing on the names that are driven by these generational secular tailwinds of AI and cloud. And there you're going to have to come to grips with whether or not valuation is extended or whether these names will grow into the valuation. Our personal view is that the multiple isn't going to really matter when the economy starts to slow and there's some of the few names putting up 20% plus earnings growth. The other area that we like to focus on and where we're looking for more names is where we have a structural imbalance in supply and demand. When you look at some of the metals and minerals and materials used for the clean energy transition, for the transition to EVs, the lithium, aluminums, copper's gotten all of the attention, but there are other names and other materials in there where we think that there's some value, particularly if we're going to have a small cap rally, which is what has caused some of the drag in the sector, as many of these are down market cap.
Greg, I don't know if this is quite a newsletter. You've changed your market view. I don't know. I guess we can't say it's bull. This is like a huge development. This is big. This is a lot of this is because of the CPI but you're not worried that this is end of the business cycle. Watch out for the more labor market slowdown. This is big news.
Well, this is not the end of all concerns, Kelly, but I always said that thesis was very data-driven. And when all of the data you're basing that thesis on pivots, you have to reconsider your view. Now, will I have a concern come fall, winter? Probably, because we are entering the down part of the cycle. And I'll have to look and see if my view of 2025 matches, exceeds, or is far short of consensus.
But in other words, let me just back up for a second, because I remember when you were often in the minority who were saying the Fed needed not only to hold rates, but even to hike them, and that you were concerned that inflation was going to remain. And there's a lot of viewers, by the way, and a lot of investors who have shared that point of view. But do you think, intellectually speaking, that view, we have to put that away now, that there's no real case to be made for a hawkish Fed at this point?
For right now, yes. I've long resisted the notion that the terminal rate was in. My original prediction back in 2022 actually was 6%. We came close, but I think the terminal rate's in for now, barring some external shock.
Wow.